All right, I want to thank everyone for joining us today. Markets have been a bit crazy over the past couple of weeks, so we've decided to bring in Mike Sorrentino and Rich Paul here for a market update.
Well, hey, Mike, how you doing? It's Rich.
Hi, Rich. I'm doing well. Given the circumstances, it's been a pretty crazy start to the week here. For that matter, the last 3 weeks, but I'm doing well.
Excellent, excellent. Yeah, no, it has been a tumultuous time period, nonetheless, and hopefully in this short 10 to 15 minute time span, we can put a little bit of clarity and calmness on what the ultimate outcome of this is going to be.
I would hope so. There's a couple of key things that I want to run through here because one of the biggest mistakes that you can make is letting this panic kind of infect and feed bad investment decisions. So a lot of times the best way to tackle that is to simply just address some of the concerns that we're seeing right now. And I think the number one question I'm getting from investors is this going to be another 2008? And I have to admit, this is a very warranted question. It makes sense. The volatility that we have seen over the last 3 weeks, and particularly yesterday on Monday, was something that we have not seen since the precursor to the financial crisis. So the question, I think, is valid, but I cannot stress enough that the odds of another financial crisis coming from this oil situation or the coronavirus or anything else in the market, the odds of a financial crisis are as close to zero as mathematically possible. When we think about a financial crisis, we think about a crisis of confidence, okay? It sounds a little hokey, but the entire financial system is really based on trust. That's the foundation, okay? If I take my money and I put it into a bank account, I expect that money to be there when I withdraw it a week or month or a year later. Okay. If I go get a loan to buy a house, or if I get a mortgage, that bank giving me the mortgage has an expectation that I'm going to pay it back. So what caused 2008 was that trust to disappear, and that is an incredibly difficult thing to happen. Okay, it doesn't happen often. In fact, in the last 150 years, it's happened twice. So the idea that what's happening right now in markets could cause that trust to erode, again, I think it is as close to zero as possible. But there are other questions out there, and I think the big one, I'd say somewhat of a more realistic question, is could this start another recession? So that, again, I think the odds are low, but let's talk about some of the things that are happening right now. I want to jump in real quick and talk about the oil situation, because what we saw yesterday, we haven't seen in 30 years in the oil market. So effectively, OPEC, the cartel that has for many decades now kind of controlled the price of oil, over the last 10 or 15 years, their power in the oil market has continually fallen. Okay, they've become less and less important, and people care a lot less about their decisions. They don't have as much control over the market. So what they did a couple of years ago was they basically recruited Russia and said, Russia, we want you to come into the cartel as an unofficial member and help us control the price of oil, because their power had been deteriorating. Well, about a week ago, Russia and Saudi Arabia got in a big argument. And Saudi Arabia wanted to cut production to raise prices, and Russia did not want to do that, because Russia does not like the fact that the U.S. energy industry is now the most powerful energy industry effectively in the world. And Russia's mad at the U.S. right now because we got sanctions on them. So basically Russia's point was, look, if Saudi Arabia, if we cut production and raise prices, then that's going to benefit U.S. producers, and we don't want to do that. So this turned into a big argument, and ultimately Saudi Arabia was so mad at Russia that instead of cutting production, they decided to flood the market with additional supply and cut pricing to Asia, Europe, and the U.S., effectively causing the price of oil to plummet. This was unprecedented, and it was also a highly emotional decision on Saudi Arabia's part. But as you can see, it caused global financial markets to go haywire yesterday.
Well,
Absolutely unprecedented volatility.
You can sure say that. I mean, the prince threw his hissy fit, and I'm telling you, the market's kind of melted down around him. And he just, as you're talking about this, Putin in Russia, I mean, their lifeline is their oil. So this has got to be just devastating to their economy if this continues for any prolonged period of time, wouldn't you think?
Yes, it does. But here's the crazy thing, Rich, is that Russia's economy is actually more diverse than Saudi Arabia. So you mentioned something earlier, a hissy fit. That's exactly what this is. I mean, we're talking about two powerful entities in the energy and global energy market just fighting each other and willing to risk their economies just to prove a point. Which I actually think is one of the reasons why this is probably not going to last. I don't think this is going to turn into another price war like we saw in 2014, right? Where ironically, it ended up being the best thing for the U.S. But I don't think it's going to turn into one of those because, frankly, Saudi Arabia has they just took Saudi Aramco public. Their entire economy is highly levered to oil. Russia is very levered to energy, but it's a little bit more diverse. So nobody wins here. Literally nobody wins. So I think at some point they're going to come back to the table and say, okay, let's figure this out. All right.
Right.
And that's the reason why I think this is going to be limited in terms of scope.
So I guess the moral of the story here is as you see these prices drop in the next week or two, you better fill up.
Yeah, fill up. And look, I mean, again, let's say I'm wrong here and this continues going forward, who's going to be all that upset about lower prices at the pump? I mean, our economy, the U.S. economy is 70% consumer spending. So every dollar that we're not putting into the pump, we could be putting into more productive areas of the economy, like taking our loved ones out to dinner, buying a Starbucks coffee, paying our kids college tuition, whatever it may be. That's way more productive than getting taxed at the pump. So I don't see, for a long-term investor, I don't see an outcome right now where I'm overly concerned, but it's important to understand exactly what's been going on in the oil market because, again, I don't want this to turn into an emotional reaction from investors.
Yeah, no question.
So that being said, let's get to the coronavirus because it was in a weird way, it was nice yesterday to not have to talk about coronavirus for 24 hours, but we're back to it. Okay. So we need again, could something like a pandemic like coronavirus cause in a recession? I think the odds again are extremely, extremely low. I mean, Rich, we're talking about a virus that, it hasn't really caused that many problems outside of the media. I mean, in the flu season last year alone, over 61,000 people died. Okay. We have a handful of people. And again, we don't want to lose anybody. Don't get me wrong. But I think the severity of this disease has been way overblown. In fact, in China, where it started, which is about 3 to 5 weeks ahead of us right now in terms of the news flow and the infection rates, where we saw a very extreme or hyperbolic rate of infection initially, it started to taper off, and we're seeing a decelerating effect now. Starbucks is back open, selling coffee. Some plants are starting to turn back on, and manufacturing plants turn back on, and they're trying to get their economy back to where it was. It's not going to happen overnight, but my point here is that's very encouraging because it's following a very similar pattern to past pandemics. Okay, SARS, H1N1, bird flu, all that other stuff. So I like to see pandemics follow historical pandemics because that makes them more predictable, way more predictable. So I sit there and I look I see what's going on right now. The Fed, I know, came in and cut interest rates last week. My guess is they're going to do it again next week, trying to calm down investors. But I think we all can agree, and Rich, you've probably seen this as much as I have, emergency interest rate cuts don't fix emergencies, right? They just don't.
Exactly.
You're going to sit there and tell me monetary policy can make people feel better that are affected by this virus. It's crazy.
Right. Yeah. I mean, the flu it's still going to be out there, but as you were saying though, I mean, I think it was China. It was just today they were talking about the rate of infections. It went from 1,000, 2,000 a day. I think yesterday they had 19. The fall off has been precipitous. I mean, it's definitely starting to turn. We got spring coming up, which kills off flus anyways. This thing is going to come and
Good point.
It's going to go. And here's the thing too, you've got less than 30 deaths, I guess. It keeps changing, but I think the last number I seen was 26 or 7. But and you compare that with you were talking about the flu numbers this year through 2/29. There's 34 million people out there with the regular flu, quote unquote. 20,000 people have died so far compared to 30. I mean, so it just kind of gives you, we got a long ways to go to catch up to just the flu. Forget H1N1, which killed, they said upwards of 500,000 people. So it's interesting. And again, as we approach spring, this thing could fold up shop real quick.
Yeah, again, it is following that past, that past pattern that we've seen with pandemics. I mean, I think the key point when it comes to the economy, though, again, 70% of our economy is what we do on a daily basis, spend money. And then if you add in business spending, that's 88% of our economy. So the question is this pandemic going to cause economic activity to get delayed or destroyed? And I think delayed in almost every circumstance will be the case. Okay, if I want to go out and buy a new iPhone, in a couple of weeks, and there are no iPhones on the shelf because China, the manufacturing in China won't, they're just trying to get back ramped up. Okay, all right, fine. I got to wait a couple of weeks and then I'll go buy my phone. All right. What I'm not going to do is cancel my Verizon bill and resort to carrier pigeons to get my information in places. I'll just say, okay, no big deal. I'll just wait till it comes. And I think we're going to see a lot of that delayed consumption. So if I had to guess, I would say that this year that we'll definitely see a lull in economic activity probably in the second quarter, but that's going to get made up towards the back end of the year. So I'm not overly concerned about any kind of impact of the economy. In fact, the economic data we're seeing recently, particularly last week with the jobs report, indicates that things are pretty good right now. I mean, it was another record job report. So when I look at the U.S., again, I use this analogy a lot. It's a lot like an oil tanker in the ocean, right? It's a $20 trillion beast, and course corrections take a very long time. And if you're looking at it carefully, you can kind of see where it's going. When I see the stock market moving around like a speedboat, all right, that tells me that it's not being fueled by the economy or the fundamentals that drive the economy. It's being fueled by emotions, fear and panic, particularly right now. And here's the deal. Fear and panic, as scary as they are in the short term, they do not derail $20 trillion economies. It doesn't work like that. So for now, I'm not concerned. And if anything, I'm looking for opportunity as this volatility continues forward. And Rich, I had mentioned earlier about, I think there's a benefit here of we're seeing a similar pattern with prior pandemics. Here's a list of over the last 40 years of all the pandemics and the subsequent 1, 3, and 6 month return after they kind of bottomed out. And as you can see in the red box there, we see this sharp decline, very violent decline, and then it's almost an equal recovery. It's this very narrow and deep V-shaped pattern. And if this is the case, investors that are going into cash right now and expecting to wait things to calm down before they get back in, they're going to miss the recovery. It's just, that's how it works. So it's a difficult situation for those that are sitting right now and having to weather the storm, but that's the best thing to do, is to kind of keep cool and wait for this thing to turn around. I would say for those investors out there that are losing sleep right now, that are worried about this and think their financial future is going to get impacted, I think they need to sit down with your team, Rich, with you or anybody else on your team, and talk about potentially some other options that may take some of the volatility off their plate. Now, notice I didn't say risk, okay? Because volatility and risk are two different things. I'm talking about volatility. Volatility is not going to impact your long-term financial future unless you let it, all right? And it is truly, it's an emotional decision, and I don't want to see investors have a situation where the volatility in their portfolio is going to make them do nothing more than take short-term pain and lock it into long-term misery by selling into this panic.
That's right, because we know timing doesn't work. It just doesn't. We've said that a million times. In my book, The Baby Boomers Retirement Survival Guide, I did a 20-year study. The market averaged about 8, while the average investor did about 2, because it's very difficult to be right twice, when to get out, when to get back in. And so it's just, asset allocation is really what it comes down to. Create the right allocation, one that you can live with. And So I always say, are you sleeping with one eye open? And if you are, you need to probably sit down and talk with somebody to say, hey, maybe I am overexposed to risk. And if that's the case, let's have a conversation.
Single-handedly, the most important thing, I'd say over 90% of investment mistakes are because of emotional responses to stimulus. And I cannot stress enough that if we can keep our emotions in check, we're probably going to meet our financial goals. More than likely, that's the case. So, as much as I dread talking politics, I think we need to. I mean, it got drowned out quite a bit last week, Rich. But I mean, we did have Super Tuesday. We have seen a dramatic shift on the Democratic ticket, and I think it's worth at least mentioning because this story has just begun. Okay, and if you think about the candidates, we've got President Trump, who clearly has a kind of more market-friendly, pro-economic campaign or plan. Bernie Sanders, kind of the exact opposite. Very, very supposedly market-unfriendly. Supposedly not as favorable towards the economy. So this huge spectrum of potential outcomes, and then somewhere in the middle, maybe not middle, maybe more leaning towards Bernie Sanders is Joe Biden. So we've got in most elections, you don't really have this type of wide potential outcomes, right? You've got a couple candidates that are kind of close to the center because that's usually where you win elections. And so you have a better understanding of the outcome, but this is a big one. So this is going to cause volatility going forward, okay? And we need to address this today and talk about it continually to make sure that we don't make big mistakes. So again, getting back to emotions, Rich, I'm sure you'd agree that what we're seeing right now is a perfect representation of politics. Stabbing in the back. One of my favorite quotes of all time was, "Politics is the marshaling of hatreds." Right. So we're seeing a lot of that right now, where there's a lot of fighting, a lot of bickering, but politics and policy are two very different things, right? Politics is I can land in South Carolina today and say something to that group, and then fly to Iowa tomorrow and say something completely different, and nobody's really going to hold me accountable for mixed messaging. My goal in politics, or the candidate's goals, is to win votes, right? It's a very emotionally driven response. So what we're going to see here, what's going to be fueling the market over the next couple of months, is politics. But politics don't last, all right? Once whoever wins the office in November, then it's policy, okay? And policy is something completely different. Policy takes years.
Right.
It takes years. It's very fundamentally driven. There are checks and balances, right? I mean, Rich, think about it this way. You think about Obamacare. Now, whether people like Obamacare or not is irrelevant. The fact is that in 2009, Obama was in the office, in the White House, and Congress, the Democrats owned Congress. And it still took, over 6 years to get that first policy in front of Americans? Something like that. So, policy takes a long time to get through. Policy is what's going to drive the long-term economy, but we don't really know what that's going to look like for some time now. So my point here is that if you see any kind of erratic volatility in markets because we get closer to November, just remember that is not going to fuel the long-term direction of the stock market. Policy will, and we're ways away from knowing what that's going to look like.
We are ways away. And just to comment on that, I look at Joe as a kind of a warmed down version of Bernie from a tax standpoint, because he's going to be increasing capital gains tax, dividends tax, corporate tax, income tax, and so it's a different tax policy. And so that's, as an advisor, it's one of the things that we look at is, are we planning for higher taxation down the road? More than likely at some point, whether it's this cycle or the next cycle, I think it's inevitable that we're going to see an increasing tax policy come into play at some point along the way. So, and right now that could happen as soon as this November, in which case, what is our approach from a financial planning standpoint?
Yeah, no, that's important. I mean, look, I utterly despise taxes, but the reality is taxes are probably going to go up going forward, irrespective of who's in the office over the next 10, 15, 20 years, right? So, and from an investment standpoint, one of the most powerful ways to impact your returns, and frankly, the one you can control the most, is through how we pay Uncle Sam. So there's no question that's a key component to any financial plan going forward. And because, like I said, it's one of the best ways it's one of the ways you can actually have some control over your financial future. So let's add this all up real quick, because I just want to touch on the economy, because we haven't. I was, I mentioned to Rich earlier today. I looked at the Wall Street Journal. I think it was Friday last week. Something like 92% of all the articles had to do with coronavirus. There was just nothing about the fundamentals of the economy. So I want to touch on that. When I look at the economy, again, 70% consumer spending, 18% business spending. So 88% of the U.S. economy is what we do on a day-to-day basis, buy coffee or whatever it may be. So for there to be a material slowdown or shift in the U.S. economy, we need to see spending fall apart. So I asked myself two questions in this situation. First, can we spend money? And the second question is, do we want to spend money? All right. Can we spend money? That's the ability to spend. Do we have access to money to spend? The overwhelming majority of spending in this country is done on credit. If I want to buy a house or a car, I take out a loan and I buy that item. So interest rates and the bank's willingness to give us money to borrow has to be there. If it's not there, the economy cannot grow. And I would say without question that currently the access to capital has never been better in our country. It just hasn't. So that is a very powerful force for our U.S. economy, and it's very sticking. If you look at do we want to spend money? That's kind of like the willingness to spend. This is very fickle. All right? Admittedly, this is much harder to assess. If you asked me this a month ago, I would say, yeah, people want to spend a lot of money. Look at what happened at Amazon over the holidays. Look at all the consumer spending that we're seeing. But things like what we're seeing in the media right now do impact spending. Now, the question is, does it destroy spending or just delay spending? And as I mentioned earlier, I firmly believe that if there are any negative implications, what we're seeing with the coronavirus is that it's going to delay spending a couple months or a quarter or two. I don't think in any way, shape, or form it's going to destroy. So, Rich, I mean, you asked me this earlier. I still give the economy a solid B+. I don't see any reason right now to panic. I think the risk of a recession is quite low. I think the risk that the economy slows down is material, but there's a big difference between a slowing economy and a shrinking economy.
No question. I think as we approach this spring and we're already seeing a housing shortage, I'm telling you, you've got treasuries that 30-year treasuries at 1%, even less. I think it's waffling between slightly above 1, less than 1. And then the 30-year or the 10-year number treasury, I mean, you're looking at, that is I think it's in the 3/4 point range. And so that's going to impact mortgage rates. We could be looking at sub 3%. I think it's around 3.1 or 2 right now. And when they make the adjustment, if they come down that low, if there was ever a time to buy a home and take out a mortgage, this is the time. I think historically this is the lowest it's ever been, as far as I know. I think you can concur on that.
I'll tell you what I'm doing later today, and this is the truth. I actually already have a phone call set with my mortgage person, and I'm talking about refinancing. I mean, I thought I got a low rate back in 2015. This is to me, I'm looking at this as a gift, as an opportunity more than anything else.
Oh, no question. Yeah, no question. And in fact, we're anticipating possibly moving, and so that's certainly if we take on any mortgage money, it's not too scary at 3%. It's like it's not free, but it's getting close.
It's flirting with it, yeah.
yeah.
So, well, with that, look, I just wanted to make sure that I kind of gave everybody some of my thoughts, and Rich, thank you so much for getting the opportunity to speak with everyone. Look, if I could just say anything right now, it's just, let's just take a deep breath and relax. I mean, last week is a good example. We saw a lot of volatility last week, but the week actually ended up, over 0.5%.
Over 0.5%.
So sometimes you see to close your eyes.
You do, and you got, like you say, the coronavirus, you got to keep it perspective. One other quick stat: the average age of the people that are actually dying from this is 80. And so it's really impacting the elder senior community more than anything else. So if you have health complications, maybe this would be the time to stay away from crowds or people for the time being. Let the next month go by, and this thing should hopefully calm down, and again, the good weather moves in, and I think the flu moves out. So I think that's what we're looking at. Another month, I think we'll be looking at an entirely different picture.
Yeah.
Perfect. Well, I appreciate everyone for joining us. And again, any questions, concerns, feel free to reach out.